One house. Bought at 32. By 47, it was generating $15,000 a year in passive income without selling it, without renting it out full time, and without touching the stock market once. And the part that'll mess with your head. The math isn't complicated. You just have to see it once. Because here's what I've noticed after years of watching people chase financial freedom. The ones who actually get there quietly without drama almost never did what you'd expect. They didn't flip 10 houses. They didn't grind 3 side hustles simultaneously. They didn't time the market perfectly. They made one decision early, one property, chosen carefully, used in a way most homeowners never even consider. And by the time their coworkers were talking about grinding until 65, they had options, real ones. Stay with me, because by the end of this video, you're going to see your own housing situation completely differently. Whether you already own a home or you're still renting, this changes the math. Let's start with the thing nobody wants to admit. Most financial advice is built around one assumption that you will work for 40 years, contribute to a 401k hope. The market cooperates, and retire sometime around 65 if you're lucky. That's the default plan. And for a lot of people it works fine. But fine is different from free. There's a separate group of people who figured out something early. Wealth isn't primarily about how much you earn. It's about how well your assets work while you're not working. And the most accessible wealth-building asset available to a middle-class American, the one that comes with built-in leverage tax advantages. And historically reliable appreciation isn't a stock portfolio. It's a house. Now I know what you're thinking. Real estate is expensive, rates are high, the market is tough, and your right entry is harder than it was 5 years ago. But the core math behind this strategy has survived every rate cycle, every correction, every recession since the 1970s. It doesn't depend on perfect conditions. It depends on time and one smart decision. Here's what that decision looks like and why most people never make it. The average American homeowner treats their house like a consumption item. They buy the nicest thing they can qualify for, spend 30 years paying it down and feel proud when the mortgage is finally gone. Paid off, no more payment, free. Except they're not free. They're asset-rich and cash flow neutral. They have a house that's worth maybe $600,000, $700,000, $800,000, and it's producing zero income. Zero. All that equity sitting there, doing nothing. This is the first mental shift you need to make. A paid-off house isn't the finish line. It's actually a sign that you've been playing defense this whole time. Wealthy people don't let assets sit idle. That's not philosophy, that's just how capital works. Equity trapped inside a property is potential energy with no output. And potential energy that never converts is just a number on a spreadsheet. So what do you do instead? Here's the framework. And I want you to pay attention here because this is the part most videos skip. They say build equity and use leverage like those are obvious. They're not. Let me show you what's actually happening under the hood. There are 4 engines running simultaneously inside a well-chosen property: appreciation, mortgage paydown, strategic improvements, and controlled leverage. Separately, each one is fine. Together over 10 to 15 years, they don't add, they multiply. That's the part that changes the math completely. Let's go through them. And stay with me on the third one because that's where most people leave money on the table without even knowing it. Appreciation first. Not the "I hope this neighborhood blows up" kind. Strategic appreciation means buying where demand structurally exceeds supply. Near growing job hubs, near infrastructure that's being built, not finished. Middle-class neighborhoods where professionals want to live, but inventory stays tight. You're not predicting the future. You're stacking probability. Here's what that looks like in practice. A $480,000 home, appreciating at 4% annually, conservative, not optimistic, is worth roughly $860,000 in 15 years. You didn't do anything. You just didn't sell. Time did the work. Now mortgage paydown. This is the most underrated engine of the 4, and almost nobody talks about it correctly. Every month, part of your payment reduces your principal. Early on, that portion is small, but it grows every year. By year 10 on a standard 30-year mortgage, you've paid down roughly 15% of your original balance, just through normal payments, without doing anything extra. Here's what makes this interesting. You're building equity from 2 directions at once. Property value going up, loan balance going down. That gap between those 2 numbers is widening every single month quietly, automatically, whether you're paying attention or not. Most homeowners don't track that gap. They just make their payment and move on. But when you understand what's actually happening, your whole relationship with your mortgage changes. It's not a bill. It's a machine running in the background. And it's building towards something. Want to know what that something is? I'll show you in a minute, but first, the third engine. This is the one people get wrong most often. Strategic improvements. And I need to be specific here because the word improvements makes people think renovation. Big project. 6 months of construction. That's not what I mean. Think targeted. Think high return per dollar. A finished basement that adds a rentable unit. Updated fixtures in a rental that justify a $150 rent increase. Improved curb appeal that moves your home into a different buyer bracket. Energy efficiency upgrades that reduce operating costs. These are the moves that return more than they cost, sometimes significantly more. The mistake that kills people financially is over-improving. Dropping $60,000 on a kitchen remodel in a neighborhood where buyers cap out at a certain price, you don't get that back. The goal is precise, surgical upgrades, the ones that move the needle on rent or resale value without draining your reserves. Because you're going to need those reserves for the fourth engine. And this one. This is where early retirement actually starts. Leverage. This is where I need to slow down because leverage is the word that makes people uncomfortable, and I understand why. 2008 happened. People lost everything. The word leverage carries weight. But here's the distinction that matters. Reckless leverage is borrowing against an asset to fund consumption, vacations, cars, lifestyle. That's how people blow up their net worth. Strategic leverage is accessing equity from an appreciating asset and deploying it into income-producing investments. That's how wealth compounds. And here's the thing I want you to hold on to through all of this. 4 engines, but still one property. You're not managing a portfolio. You're not juggling tenants across 6 zip codes. You're making one asset do the work of many. That's the whole idea. Let me show you what this looks like with real numbers. You buy a home at 32 years old. $480,000. 20% down, $96,000. Mortgage sits at $384,000 at a 6.5% rate. Your monthly payment is around $2,400. You find a way to offset that cost renting a basement unit, taking in a roommate for the first couple years, whatever your situation allows. Not to get rich, just to reduce your monthly burn. Now you wait. Patiently, life happens. Career moves, maybe a family. 10 years pass. At 4% annual appreciation, that home is now worth roughly $710,000. Your mortgage balance has dropped to around $315,000. That's equity of almost $400,000. And here's the moment most people miss completely. $400,000 sitting inside that property is doing nothing for you. It's not generating income, it's not compounding, it's not working, it's just there, like cash stuffed inside a mattress, except the mattress happens to be worth $700,000. At this point, most people have 2 instincts: pay the mortgage off faster, or do nothing and feel good about their net worth on paper. Both of those instincts leave money on the table. The move, the one that actually accelerates early retirement, is to access a portion of that equity through a cash-out refinance or a home equity line of credit, and deploy it into income-producing assets. Let's say you pull out $220,000. You invest it conservatively, diversified dividend stocks, bonds, REITs, or some combination targeting a 7% average annual return. That's $15,400 per year in passive income, every year, from equity that was previously producing 0. And that number grows as the investments compound. I want to stop here for a second, because this is the part where I usually get pushback. That sounds risky. What if the market drops? What if home values fall? These are legitimate questions, and I'm not going to wave them away. Yes, markets drop. Yes, values fluctuate. That's why this strategy depends on buying conservatively, maintaining a significant equity buffer, never accessing more than 50% of available equity, and investing in diversified, income-producing assets rather than speculative ones. The difference between this and the people who blew up in 2008 is discipline and margin. They were leveraged at 90% with no buffer. This strategy builds in a cushion by design. And here's the asymmetric advantage of real estate versus stocks that most people overlook. If the stock market drops 40% in a year, your portfolio is down 40%, period. But if real estate values drop 20%, which is historically rare and usually temporary, your mortgage doesn't increase. Your payment stays the same. You just wait. And historically, residential real estate in supply-constrained markets recovers. That's a different kind of risk profile. I want to be real with you for a second. A few years ago, I was not thinking about any of this. I was working long hours, spending most of what I made, and telling myself I'd figure out the financial stuff later. Later, that word that quietly steals your options. I had a good income. On paper, things looked fine, but I had almost no assets working for me. My net worth was basically my savings account, and whatever was left in my retirement fund after I'd taken one too many early withdrawals when things got tight. I remember sitting in my car in a parking garage one night after a particularly brutal week at work, thinking if I had to do this for another 25 years, I genuinely didn't know if I could. Not because the job was terrible, just because the idea of being dependent on a paycheck indefinitely felt suffocating. That was the moment I started paying attention differently. Not to get-rich-quick schemes, not to crypto, just to the boring math of how assets actually build wealth over time. And one property kept coming up over and over as the most accessible on-ramp for someone starting from a normal place. I'm not telling you this to make it personal. I'm telling you because I think a lot of people watching this are in a version of that parking garage. And the answer isn't complicated, but you have to start. Let's talk about the property selection piece, because this is where most people either win or lose before the strategy even begins. The wrong house is the one you fall in love with emotionally. The charming Victorian with the expensive roof. The fixer-upper, that's actually a money pit. The house in the neighborhood that feels like it's about to take off, but hasn't in 15 years. The right house is boring. Middle-class neighborhood, strong rental demand from working professionals, functional layout, low deferred maintenance. Some value-add potential through targeted upgrades, not a full gut renovation. You're looking for three things specifically. First, rental demand. If you needed to rent this property tomorrow, could you? Is there a pool of qualified tenants who would want it? Middle-class neighborhoods near employment centers typically score well here. Second, supply constraints. Can a developer easily build 50 similar homes in the same area within 5 years? If yes, your appreciation upside is limited. If the neighborhood has natural barriers, geographic zoning, established infrastructure, supply stays tight, and values hold. Third, value-add potential. Not a project, just opportunities. A basement that could be finished. A layout where a wall could be removed to improve functionality. Cosmetic updates that add rental value without major capital outlay. The difference between buying right and overpaying compounds across decades. A $50,000 overpayment at 32 isn't just $50,000. It's the lost compounding on that capital for 15 years. That's a number that would genuinely surprise you. Now let's fast forward. You've bought the right property. You've optimized it. The equity is building. You've done your first strategic equity deployment around year 10. What does year 15 look like? The property now worth somewhere between $800,000 and $900,000 in a reasonable appreciation scenario is still appreciating. The mortgage which you refinanced at year 10 has been partially offset by the rental income you've maintained on the property or portions of it. Your invested equity from year 10 has been compounding for 5 years. At 7%, $220,000 over 5 years becomes around $308,000. That's generating over $21,000 annually in passive income just from that one equity deployment. Meanwhile, your monthly property expenses are being offset by rental income. Your net cost of housing may be near zero. Add it up. Your passive income from invested equity is approaching or exceeding $20,000 annually. Your housing costs are near neutral. Your total property value continues to appreciate. You're 47 years old. And work is starting to become optional. This is the part that's hard to explain until you feel it. When your passive income starts approaching your monthly expenses, even partially, something psychological shifts. You stop making decisions from desperation. You negotiate differently at work because you have runway. You take risks you'd never take when the paycheck was the only thing between you and financial panic. Financial security isn't just a number. It's a different operating system. And the beautiful thing about this approach is you're not living like a monk to get there. You're in a solid home, you're building wealth. You're improving your life now and building toward freedom at the same time. That's different from the save 50% of your income and eat rice and beans school of early retirement. This is about making one asset work intelligently. Let me address the objection I haven't addressed yet. Location. What if you live somewhere where housing is completely out of reach? San Francisco, Manhattan. Parts of coastal California where even a modest home is over $1 million. Here's the honest answer. In those markets, this strategy is harder, but not impossible. $1 million property with the same appreciation, dynamics, and the same equity deployment math produces bigger, absolute numbers. But it requires more capital upfront and more patience. For most people in those markets, the play is either a longer timeline, a strategic relocation to a market with better entry prices and still strong appreciation dynamics, or a hybrid approach where you start with a smaller property in an adjacent market. But here's the thing. 70% of Americans live in markets where a solid, well-located home is still accessible at reasonable prices relative to income. The Sun Belt, the Midwest, secondary cities in the South. These markets have shown strong appreciation over the past decade and still have reasonable entry points. You may not be able to execute this strategy in the most expensive zip codes in America, but the most expensive zip codes aren't where this strategy was built to live. Let's talk about risk one more time because I want to be specific, not just reassuring. Real estate can go wrong in a few specific ways. Vacancy risk. If you're relying on rental income to offset your costs and the property sits empty for 3 months, that hurts. The fix is simple. Maintain a 6-month cash reserve. Don't run your finances so tight that a single vacant period creates a crisis. Rate risk. If you've done a cash-out refinance and rates are significantly higher than your original mortgage, your new monthly payment goes up. Only access equity when the after-tax return on deployed capital clearly exceeds the new borrowing cost. Neighborhood risk. Areas change. What looks like a strong rental market today can soften. Buy in established supply-constrained neighborhoods with diverse employment bases. Avoid areas dependent on one employer or one industry. Market correction risk. Values drop. It happens. The key metric isn't your paper value, it's your cash flow position. If your expenses are covered and you're not forced to sell, a temporary correction is irrelevant. You wait. Values recover. Managing one property through these risks is completely doable. You can see it clearly. You can respond quickly. You have one set of numbers to watch, one market to understand, one asset to protect. Compare that to someone running 12 rentals, 12 sets of tenants, 12 maintenance budgets, 12 mortgages. When one goes sideways, it pulls on all the others. That's not a wealth strategy. That's a second job with unlimited liability. One property isn't the cautious choice. It's the intelligent one. The people who blew up in 2008 weren't the ones who owned one well-chosen home. They were the ones who got greedy and stacked leverage across properties they never should have bought. One property, managed well. That's the version that survives downturns, survives rate spikes, survives market corrections, and still comes out ahead. Here's the part nobody says out loud. This strategy requires patience, not genius, not connections, not perfect timing, just the willingness to make one smart decision early and let time do its job. The people who retire at 47 aren't the ones who worked hardest. They're the ones who put one asset to work earliest and let compound growth run its course. While everyone else was debating index funds versus crypto, debating when to buy versus continuing to rent, debating whether the market was too high or too low, these people bought one solid property, optimized it, and got out of the way. That's not a secret. It's just discipline applied consistently over time. So where does this leave you? If you already own a home, the first question is how much equity do you have? And more importantly, what is that equity doing right now? If the answer is nothing, you have a decision to make. Not immediately, not recklessly, but with intention. If you're still renting and wondering whether to buy, the answer isn't always buy. The answer is buy the right thing when you can do it without overextending in a market where the math works. And then optimize it from day one, not as a home, as an asset that happens to be where you live. The difference between those two mindsets over 20 years is the difference between working until 65 because you have to, and having options at 47 because you planned. One property, not 10, not a real estate empire, not a side hustle that consumes your weekends. One house, bought right, used right, given time. That's it. That's the whole strategy. And the reason most people never execute it isn't because it's complicated. It's because it's almost too simple. We've been conditioned to believe that building wealth requires complexity, multiple income streams, multiple assets, a constantly optimized portfolio. But the people quietly retiring in their 40s aren't doing more. They're doing less better. One property is all you. And if this changed how you see your own situation, good. That's exactly where it starts. Not with a perfect plan, not with perfect timing. Just a different way of looking at what you already have. Keep watching. There's more where this came from.